Okay, welcome everyone. We'll start our first lesson about Unit 4, Costing and Management Accounting. And today lesson will go through learning outcome 1, understand cost accounting techniques and the pricing strategy. That will be focused. My name is Anyum Satar and my email address anyum@ukversity.co.uk. Please, if you have any question, just drop me email on my email address. Before starting this unit, we'll look, what we're supposed to be learn and what is the aim of this unit. Okay, let's please. So aim of this unit, individual have the skills to provide the relevant information in the short term and the long term decision making. So we'll go through you're supposed to have a skill, what is meant by short term information, long term information. You have ability to interpret the information and use the information in a decision making perspective. So all this will be focused today lesson. So during this unit. So today lesson key focus is understand the cost accounting techniques and the pricing strategy. We have 5 assessment criteria. So which will go through, describe the different costing approaches, which will go through different cost approaches, those used to provide the information. Like we'll go through marginal cost, absorption cost, fixed cost, variable costs are different costing. Explain how the pricing of the organization and competitive advantage. Competitive advantage means the advantage against your competitor. It can be you are offering lower cost. Think about the Ryanair and various others. They have a competitive advantage. So then we can look around, explain the importance of contribution, which we'll discuss, and then analyze the advantages and disadvantages of the costing approaches. And then we have evaluate the link between the contribution and the cost volume profit analysis. So that's all will be focused today lesson. Okay, next then we have a learning outcome 2 and 3, and we have 3 learning outcome, and almost in every learning outcome we have 3 assessment criteria. So today lesson we're supposed to go through traditional marginal target costing, and then we have a marginal costing, cost plus pricing, competitive pricing, and all, selling per unit and the cost less variable cost per unit, what is the contribution. So all this will be focused to the lesson. So we'll start. Please, anybody any question if you have before start? And if you're listening, are you there in chat room? So please, carry on chatting, and you can speak and you can on mic as well. Okay, we'll start. So now it's good to think about your current knowledge from 1 to 10 on scale 1 to 10. What do you know about management information? Why management information? What do you know about contribution? What is meant by contribution? And what your current knowledge about break even? So based on 3 areas, so you can rate yourself 1 to 10. You're really confident you are 10, 8, 9, 7, or you never heard about maybe 4, 3, or information maybe just yes. So just think about the inductive contents, what we supposed to be learn, as I mentioned in the unit content. So today lesson will go through all this, so we'll discuss about traditional absorption costing. Absorption costing mean you absorb all the costs into the unit. Marginal costing mean as the cost of every successive unit is called marginal, or additional cost of additional unit, that's called marginal cost. Marginal cost is also known as all the variable cost, because the variable cost changes. So additional cost mean variable cost. Target costing, so it means if you want to be on the profit, your target will be like you want to be 30% profit. So it means your 70% cost. And if you sell something £100, 70% will goes towards your cost, and the 30% will goes towards your profit, or we call contribution. So that's that's the way we calculate the target costing. Responsibility accounting is very important. We have a different, the profit center or various centers that we can allocate the responsibility, and we can give the profit, we can give the commission, we can give the efficiency related pay based on the responsibility, or the budget, we allocate according to the responsibility. Then we have a special different pricing strategies, marginal pricing, which is mean the based on the variable cost, cost plus pricing, customer based pricing, and all these, the pricing techniques we'll go through. Then we have a contribution. What is meant by contribution? Contribution is means selling price minus variable cost equal to contribution. So all this will go through today lesson. And if in the meanwhile, if you have any question, you have my email address anjum@ukversity.co.uk. Just send me email if you're listening this recording as well and you have any question. We'll start first. Okay. Describe different costing approaches used to provide the management information. First of all, it's good to know what is the difference between management accounting and financial accounting. We need the data to prepare the management account and financial account, and these accounts provide the information. So management accounting is for internal decision planning, controlling, budgeting. All this come under the management accounts. So like think about what is the definition of management. So what is the definition of management? So management is a process of designing an environment to achieve predetermined objective. So if you're a manager, your job to be achieve objective, you design an environment to achieve your objective. Yes. So objective mean end result. Objective. So today lesson our objective. You know about the pricing strategy. You know about what is meant by contribution. You know the formula of contribution, and you know what is meant by break even. And all this is the key. Objective is mean end result. End course of action. You're doing this course, end of the course, what really you want to be achieved. You want to be achieved your qualification ATHE level 4 diploma in accounting. That's your objective, end result, end of course of action. What really objective? Always we set SMART. Anybody knows SMART? Specific. So we can say specific, measurable. Objective need to be achievable. Objective need to be realistic, and objective need to be time bound. So always we need to be realistic and time bound. It mean in how long it will take you to achieve your objective. So that management accounting is the internal that provides the internal information that help the planning, controlling, and making the future decision. And the costing is part of the management accounting. Financial accounting is external, like we prepare the financial statement, income statement, profit and loss, equity statement, and all we publish, and any company's performance you would like to see, and you can by using their financial accounts. Okay, next we're looking now management information system, where this information is coming from. So we need to look around the management information. Hope so you guys can see. So information system are a combination of the plan, procedures, suitable design form, and appropriate organization structure. Manager who capable of using the output is produced to assist them in administration and use available resources. The output from the system falls into two groups. Routine reports are the transactional documents such as pay, invoices, and all these provide the information. So information system process the data, like in term of the transaction, like you maybe heard about Sage, QuickBook, and various other accounting software we can use, and produce output for planning, recording, processing transaction, monitoring, measuring performance, controlling decision making. So store and information, communication information, so all come under the management accounting. Anybody any question, guys? If you have any question, please carry on chat in the chat room. If you're listening this recording, please send me email. And types of the cost, the main cost elements is the material, labor, and overhead we call. So it's always good to be look around the material. How much material required? What will be the labor cost? What hourly rate paid? You will use existing labor or you will hire new labor? Look around the legal requirement as well. NI contribution, employer contribution. Look around if you recruit the new employees like apprenticeship route. How much is uh, government is funding. So all these, the issues to make the right decision, we need to be look around these. Anybody, any question? Next, we can look around direct cost. It directly traceable to end of the product. Those we call direct cost. The cost which is indirect cost is also known as the overhead cost. Direct cost also known as the prime cost, where direct material and direct labor, if you add them together, that's called direct cost. And indirect cost, indirectly, we can't trace it, we have to observe it. Like, think about, we're doing advertising. Advertising is whole organization. So that indirect cost, we need to be allocate how many types, or how many times we're doing advertising, for how many products we are doing, how much time we use, and we can observe on different basis. And or think about the example of room. You're living in a house, shared accommodation, your room is smaller than other, and if anybody say to you, share equally your gas electricity bill, or share equally the cost, you will say, come on, I'm living in the small room, I should pay according to the size of the room. So you can cost divided by total square foot area of the house and times by how much area your room, so you can allocate the cost accordingly. So in direct cost, different basis we observe, we will go through absorption costing methods as well. Unit cost card, we can calculate the cost. Direct material, direct labor, direct expense is equal to prime cost, and production overheads, those are indirect cost. Then we call production cost. Then we have a non-production cost, selling, distribution, and admin. These are non-production, but it's still cost, or we call overhead costs. It can be fixed and variable as well. And fixed cost means stay the same. Variable cost means the cost change with the level of output. And semi-variable, where the fixed and variable cost together, we call semi-variable. So today we'll go through the valuation of the different costing elements, material, labor, and expense, make up the unit cost, and the production may be arrived a number of different ways. So batch costing, absorption costing, job costing, marginal costing, process costing, and other is the absorption. Yes, I mentioned, and target costing as well. Okay, so what is the absorption costing? The objective of absorption costing to include the total cost of the product and service as shared to the organization production overhead. And appropriate shares mean the amount of the reflect the amount of the time and the effort has been gone to the particular product or the service. Absorption costing is necessary inventory evaluation, price decision, and establish the profit for the product. It's also known as absorption costing is a full costing. So many people, especially when they start the business, they say, I'm charging this price for this product. They normally say how much ingredient you use, how much this and that, but they have invested own money. They are working for the business. They should take out the salary out of the business as well. They should observe all other costs on every monthly basis, so they can see, because especially gas, electricity bills, and various, and many businesses is collapsed within 6 months or within the first 2 years. So the reason is because, of course, is a costing method we need to be, and we need to be fully understand. So 4 stages of absorption costing: allocate, expensing, overhead, apportionment, reapportionment, and absorption costing into the unit cost. Like different department provide different services, and we can observe their costs. Then next is called activity based costing. Activity based costing, as the word, if your activity increase, your cost should be increased as well. And your activity base, you need a cost driver for this. Cost of the inward department, total cost is a 10,000. Total deliveries, we're doing 200 deliveries of, and 1,000 delivery we are doing, and different department doing the number of delivery different. X department, for suppose, they have 200 of these delivery related to 2,000 product of X were produced. So cost per unit of the cost driver, so 10,000 cost for 100,000 deliveries. So you can say 10 pound is per delivery is cost you. So how many delivery we have a product X, 10 times 200 delivery product X, because that's 800 deliveries. Uh, we is for various other. It's mean 9,800 delivery for various other department. So we can say that the contribution of the cost should be shared the to department X is 2,000, and X department is making how many units? they're making 2,000 units. So it means every product, every unit is cost them £1 delivery. So you can, when you decided the pricing, so you can say £1 will be the delivery cost as well, which you can observe. Okay, job costing is the unit cost that consists of the single order or the contract. Like you want to extend a house, that's one job, and the builders, they look this job, and the maybe next house they want or somewhere else they have a different job. So each job they give the separate costing and the separate contract for this. Okay, then batch, in batches we make the units, total batch cost, how much is the cost, and then number of unit in the batch, and you can divide, like you want to buy a Lucozade, 4 pack of Lucozade multi-pack is £2. So you divide £2 divided by 4, you can say, okay, this each cost me 50 pence. So that's the batch or the we call, and the unit cost you can find. Then is a service costing concept is quite popular. The two main types of service provided by the company operating in the service industry, or service providing the company in the service. So we can look around these, the service costing. The characteristic is intangible, simultaneous service, perishable, heterogeneous, can't be expected to do the same service every time. So we need to be calculate the cost of it. So each time to serve the customer, and it's called you the time. So many service are the profit seeking, but they are not. The purpose of the service costing might be they will provide the management information on the cost and the efficiency rather than establish the profit or the loss. Anybody any question? Okay. Then, as we mentioned earlier, responsibility accounting is a system of accounting that operates the revenue and the cost into the area of personal responsibility to monitor and assess the performance of each part of the organization. So types of the responsibility center: cost center, control costs, variance analysis, and efficiency measures. That can be responsibility center is look the revenue and the comparison of the budgeted and actual revenue, what is your budget, sales, what your actual sales. So profit center, control cost, sale volume, and profit and return. Investment center, cost, revenue, and investment policy are return on capital employed. So that's all, under the responsibility accounting, and we can allocate the budget as well accordingly. Next, we have 1.2. 1.2 is explain the pricing strategy. So there are the different cost-based pricing. Pricing is determined by adding the profit element on the top of the cost. So that's called also markup. Markup mean what cost you can sell more than the cost, and you can have, I want to be 30% profit whatever my cost will be. So I add in my cost. So if cost is 100, so my selling price should be 130. So 130 minus 130 will be my profit. So customer based pricing, we look, different customer and their affordability. Like, we look in per capita income, earning per in the country. So we can look around the purchasing power of the people in developing and developed countries have a different. So we should set the price accordingly, and we need to be look around in detail. Okay. Next, the competitor pricing. Of course, then if we're just focusing on the costing, but not, so we need to be look around the competitor. We need to look around the last demand and supply, all this, and to decide the price. Okay. Next, we're looking here this involve the price adding the fixed cost amount of the percentage to the cost. A cost plus pricing, and then it's a quite old fashioned and sometimes decredited pricing strategy. So we can look around the customer are not too bothered with the cost and make the product. Cost plus is a markup pricing, as earlier I discussed, like think about we want to be £50 profit on the top of the unit cost. So unit cost is 100, markup is a 50, so selling price should be 150. So this is called cost plus pricing strategy. We can use it. Like in the UK, this is one of the example, 2.4 times cost of the retailer pay to the supplier. So we need to look around the wholesale cost of the product is a 10, and retailer will look, 2.4 times 10. So we can look around, they want, the 24, and they equal to the mark of £14. The selling price is £24, 24 less the bought cost is 10. So the main advantage cost-based pricing is selling price is relatively easy to calculate, and if markup percentage is applied constantly across the product, then the business can also predict the more reliable what will be overall margin in. So that's why the cost-based pricing is good. Then the customer-based pricing is penetration. Sometimes we keep the lower pricing tax, and this is to increase the shares in the market, and then setting the lower price initial entry of the price can be. Then next strategy, encourage customer to switch to the new product. That will be like, think about the pound land. Initially everything is a pound, then they add 2 pound and 3 pound worth of the things as well. So penetration pricing is commonly associated in the market objective, increasing market shares. That's the key objective in the short term. Pricing is a result is a lower profit, but would be case prices will set higher in the later stage. So that's called penetration pricing. Okay, price skimming. Skimming mean is a high price, like think about when is a technology product early stage, early product life cycle, you charge, higher price, and the lower product life cycle, where the decline stage, you can charge the lower price, because the shares and they carry on declining and the demand, and you need to be look around, and you have to be look around the profit margin is carry on dropping in different stage. But early stage, think about iPhone and various others, always the skimming pricing. Or loss leader, sometimes people sell the things on the loss. The reason is a loss maker, because you want to be market shares, you carry on capturing and kicked out your suppliers. You may be heard about dumping and anti-dumping. Dumping and means selling, like the Chinese company, some been they selling steel cheaper than the home country. They are, because even is a delivery cost involved. Why they selling cheaper than the cost, or less than the even the cost? The reason is, what we'll do now, we will be sell less will be in the last few years, and what will be happen, other company they will close their business, and ultimately will pick and will increase our prices later date. So this is all about loss making. So next we looking explain the importance of the contribution. What is meant by contribution? Marginal cost is the cost of the unit produced or the service will be added where not produced or provided. It's called variable cost. So contribution is equal to sales revenue minus variable cost. 1 unit selling price, 1 unit variable cost is equal to, what is the variable cost? Direct labor, direct material, or any other cost. The cost which change with the level of output is called variable cost. So what we'll do, the marginal cost is only variable cost charged to the cost of product. Closing inventory are valued at the marginal cost. I mean variable cost, fixed cost, or the overhead cost is treated as a period cost. And period costs are charged full into the statement of profit and loss. If the sales increase one of the item, the profit will be increased by the contribution of one item. So this is called the contribution per unit, and we normally calculate the break even. Fixed cost divided by contribution is break even. So these are all the formulas. Its selling price minus variable cost is our contribution per unit. Then the profit, sale volume times by contribution per unit minus fixed cost equal to profit. So if you want to be find the break even, how many units you will be sell where you will be no profit, no loss. So fixed cost divided by contribution, thus give you contribution in unit. How many units you will be sell, you will be break even. If you times by that with the selling price, you can find how much worth of the sales you will make, you will be at the break even. So contribution required to be break even divided by the contribution per unit, and you can find how many units you will be sell. Then the required, what is the contribution sale ratio is mean, what is the selling price, what is the contribution per unit, and you can times by 100, you can find how what is the contribution sales ratio. So all these are the formulas, we can use it, and we can find the margin of safety and target profit, whatever you want to be at. So let's we'll go through here. Fixed cost plus target profit divided by contribution, so you can find how many units you will be sell at the you will earn the certain. So break even point, first fixed cost divided by contribution. Fixed cost is 5400, contribution selling price 15, cost is 12, the contribution is a 3, 5400 divided by 3 is 1800 units. If we'll sell, we will be break even. You will see here we will be all given. Then the cost to sale ratio is the contribution per unit divided by the selling price time by 100. So you can find there is the ratios is a 20 there. Break even point 54 divided by 20. So if you sell and that's 27,000 pound worth of the sale, if you made, you will be break even. Sale volume to achieve the target profit, which was 3300, 5400 plus 33, that's in your fixed cost plus desired profit, which you must want to be to sustain in a business, divided by 3. You need to be sell more unit, 2900 unit. Here 1800, there 29, so you can. Then margin of safety is the how much you will be saved. Our target budgeted sale is 3000. Our break even is 1800. So if you do, you will be saved by 1200 units. So if you want to be fine, 3000 minus 1800 divided by 3000 times by 100, 40% you will be saved. If you are break even at this point and our budgeted sale at this point, the difference is margin of safety, or we can find as a percentage. So this is the chart. You will see the break even point is the no profit, no loss. If we have a here will be loss. If we selling more than that, that will be the profit. Okay, you will see there the break even, budgeted profit, budgeted fixed cost, and budgeted contribution, and you will see there the difference between there. Here is, yes, this is up to the no profit, no loss. If you're selling more, then that will be profit, and if it from this to this, if your budgeted sales is higher than the break even sales, so that will be a margin of safety. Okay, this is the profit volume chart as well. You will see the break even, where the profit and where the volume. If you increase the volume, your break even and the contribution will be. You keep the price same, of course, you need to be look around how many units, and of course your profit will be carry on increasing. Limiting factor, as the word is also, you may be heard about the word constraint. Constraint is mean limiting factor. It can be labor hours, it can be the cost, it can be any other factor of production can be limited. And we have to find, according to the one great scholar Neil Robin, he mentioned we have unlimited wants, we have limited resources. So with these limited resources, we have to use effectively. If like, if I'll grow the crops, wheats give me contribution of per acre or per ton maybe, and I can earn, the 1,000 pound. But you need to look around, if I'll grow the mango, how much I can earn. So we need to be decide either I'll grow the wheat or either, because the limiting factor land is limited. So we need to be find higher contribution unit will produce, or you may be heard about relative advantage theory in economics. Maybe the country, those are expert, or the weather is suit them, they produce those things, and other country produce other thing, and that's, everyone will be well off. So then next we're looking, M1 is analyze the advantages and disadvantages of different approaches. So we look around the marginal cost is the closing inventories are valued at the marginal cost of production. Absorption cost is also known as the full cost. So inventory level will be increase and decrease, based on the inventory evaluation method, and based on the marginal costing and absorption costing, which costing method we are using. Okay, argument in the favor fixed costs are the incurred in order to make the output. So it is only fair to charge all the output with the shares to these costs. Closing inventory will be according with the accounting standard. Appraising product, contribution give the indication of the whether the fixed cost is being covered or not. So that's why it's good to be, we can. But when we look the argument in the absorption costing is irrelevant when short-term decision making. It is a simple to operate. There is no arbitrary fixed cost. We need to look around fixed cost in the period will be the same or regardless at the level of the. So we need to look around. The full cost is the cost of the period, realistic value, closing inventory, all will be. So we can say under or over absorbed, but absorption costing give the manager the wrong signal and the costs are the produced. So not to be meet the demand, but the absorbed allocated expenses. So that's the, advantages and disadvantages of both methods, and we can look around. Next, we have 1D1 is evaluate the link between the contribution and the volume of the profit. So when the considering output, the decision how many units to be produced or sell in the short term, the decision making often focusing on the contribution. The key decision related to how many units do we need to be break even, what is the margin of safety to expect, how many units need to be sold to achieve the target profit. So fixed cost divided by contribution. So we have a 25 minus 20 is 5 is a contribution. So fixed cost is a 50, 50 divided by 5. So we'll need to be sell 10,000 units will be break even. If we'll decide the change in the unit the selling price and the variable cost stays there, so our contribution will be drop and we need to be sell more unit to be at break even. So always decision making we need to look around. To calculate the level of activity that requires the generate profit, required profit divide plus fixed cost divided by contribution. We want to be on 40,000 pound at least, the profit. So we need to look around the required profit is a 40,000, fixed cost is a 50,000, contribution per unit was 5. So we need to be sell 18,000 unit to be at break even. So if normally without target profit, we need to sell 10,000. If we'll target profit, we need to sell 18,000 units. So if we sell 18,000 units, we can earn the profit of 40,000. Okay, the margin of safety is the difference between the budgeted level of activity and the break-even level of activity, and this is expressed in the term of the unit sales value, and the percentage. So all this, we can use this safety level, like I mentioned in the previous one, 13,000 is my budgeted sale, 10,000 was my break even, so 3,000 is safety level. So budgeted sale minus break even sale divided by budgeted sale time by 100, that give me as a percentage. So I'm 23.1%, I'm safe. So this is contribution ratio formula you want to calculate. So the contribution, what was the per unit, and what is the sell per unit, and times by 100, you can find how many percent is contribution. So fixed cost divided by contribution to ratios, you can find how much worth of the sales you will be at the break even, and the required profit divided by contribution per the sale ratio, so divided by, and you can find how much worth of the sale you will be make to achieve the desired profit. You can simply 18,000 times by we said 25 pound. So if you do, and you can calculate as well, that's way as well, and you can different ways to calculate it. And the total contribution break even chart, you will see as we discuss here. Here is a loss if you, here is a break even, no profit, no loss if you sell more than that. So that will be our profit. So you will see under this one, here is our break even point where no profit, no loss. Here is the loss of 4 if we'll sell more these units, so we'll be at the break, we'll earn the profit. So we can look around, and there will be higher margin of safety as well if we have a budgeted sale. Okay guys, I copied the link for you to watch what is the break even, and it's good to be watched and listen to enhance your understanding break even, decision making, short term and all, and the information. And then I copied the link for you to do the quiz. Please, it's quite good. Just copy this and enhance your understanding about the cost volume profit analysis, or we call break even analysis, short term decision making and information, fixed cost, variable cost, and that's all today lesson. Anybody any question? So today lesson we learn about the pricing strategies, what those are. We learn about the cost plus pricing, we learn customer based pricing. We discuss about management information, where the information will come from. We discuss about unit cost. We discuss about responsibility accounting. We discuss about break even of the CVP, cost volume profit analysis. That's all today lesson. If you have any question, anyone, please feel free to drop me email on my email address anjum@ukversity.co.uk, and I hope speak to you all during our next lesson. Thanks for listening. Thank you. Bye bye.